Why does Bank B have a higher borrowing capacity than Bank A even though the interest rate is higher? Well, this is because of the assessment rate. An assessment rate is a buffer that the lenders put on your home loan application assessment in the event of market fluctuations over that 30-year loan term. So how does it affect your borrowing capacity? Well, in this case, Bank A we're going to say is your tier 1 and tier 2 banks and your big 4. So their rate, as an example, is 5.72%. Borrowing capacity for this example, this client can service $641,000 with their monthly home loan repayment of $3,733 per month. So Bank B, let's say this is a tier 3 lender, their rate is 6.69%, their borrowing capacity is $706,000, which is about $60K more than Bank A, but their monthly repayment is $4,557 per month, which is $824 extra per month than Bank A. Now you're thinking, how can this be possible? Well, it's down to the assessment rate. So with Bank A and a lot of tier 1, tier 2 banks, they will charge a 3% assessment rate buffer on their current interest rate. So for the same example, the rate's 5.72%, their assessment rate will be plus 3%, which is 8.72%. So for Bank A, you're assessed at $5,039 per month. Now for Bank B, they have a lower assessment rate of 2%. So we add 2% to this rate here. So 2% of 6.69 is 8.69%. And our stress repayment, which we have to meet to the bank, is $5,028 per month. And both these loans are 30 years and they're both exactly the same. So why investors especially use tier 3 banks a lot when they start to scale their property portfolio is because the assessment rate on the new lending and current lending is lower, meaning that you can borrow more essentially to what you want to purchase. However, it comes at an opportunity cost. The opportunity cost is in the interim, you're going to be paying $824 per month until you can get down to this figure here and refinance later on with a tier 1 bank. So that's sort of the plan and structure that is put in place. Again, these are P&I variable loans, so you're building equity in the property as soon as you purchase it. It's the same with interest only as well with the rates and the assessment rate too. Now, tier 3 lenders have an advantage where, depending on their policies, they have lower assessment rates than tier 1, and also they can take actual repayments as opposed to a buffered repayment. So for example, if you're paying interest only on a loan and you take it to a tier 3 bank or a Bank B, they can actually assess your home loan application on what you're paying currently. So Bank A would assess it on the P&I rate of what it would be after the IO expires, but in this case, Bank B will take it as if. So there are a whole heap of policies out there, especially from tier 3 banks, to help improve your borrowing capacity, but it does come at an opportunity cost that you have to consider. If you'd like to know more about purchasing your first home across Sydney or an investment property across Australia, feel free to book a game plan call link below and we'll be happy to help you.